Hello everyone, this is Eve. Welcome back as we dive into the latest on U.S. markets. Today is Wednesday, August 270, 2025. And our main topic is, Trump once again reaches into the Federal Reserve bonds fall, stocks rise. What's really behind this? Before we get started, don't forget to like, subscribe, and hit the notification bell so more people can discover our channel to keep us motivated to bring you fresh financial insights every day. Let's begin with yesterday's U.S. markets. Overall, the major indexes traded in a relatively flat range, although there was a late session rally. The broader trend remained choppy. Investors are all waiting for NVIDIA's latest quarterly earnings, which many see as the key catalyst. But earlier in the day, a lighter headline unexpectedly grabbed the spotlight. Stocks closing higher was linked to Taylor Swift announcing her engagement to NFL star Travis Kelce. Sounds a bit far-fetched, right? But there's actually some logic here. So-called Swiftonomics has already had a very real impact. Her concert tour added roughly $5 billion to U.S. GDP, with each city on her tour bringing an estimated $150 million to $200 million in additional spending. Hotel prices in those cities surged 30% to 50% during her shows. That's what some are calling Taylorflation, if the engagement news proves true. Related industries like wedding planning, fashion, and jewelry could also see a ripple effect. A fun headline, yes, but one with economic underpinnings. Now, back to the numbers. The Dow Jones Industrial Average rose about 0.3, the S&P 500 climbed 0.4, and the Nasdaq gained roughly 0.4% as well. The Philadelphia Semiconductor Index stood out with a 0.9% increase. The Russell 2000 also outperformed, up 0.8, looking at the past few months. The Russell 2000 has been especially strong, up about 6% to 7% so far this month, marking its best monthly performance since November 2024. And it has now risen for 4 straight months with a cumulative gain of 20, the best stretch in more than 4 years. This shows that the market is no longer relying solely on mega-cap tech stocks. Small and mid-cap names, as well as cyclical sectors, are catching up. That's a healthy sign for the market overall, and exactly why we've been emphasizing that the bull trend remains intact. The Nasdaq and S&P 500 have already set new highs, the Dow eventually followed, and now it's the Russell 2000's turn to play catch-up. Looking forward, with Fed rate cuts on the horizon and hopes of a soft landing, small cap and growth stocks could continue to outperform. Of course, before further upside, it wouldn't be surprising to see a normal 10% pullback. That's simply part of a healthy market cycle. Remember, strong trends are built through steady consolidation, not by going straight up in a line. As we like to say, the goal isn't limit up every day, but no stop to the upside. Now, the biggest story of the day, Trump once again extended his hand into the Federal Reserve. On his social media platform, he released what looked like a termination letter, announcing the removal of Fed Governor Lisa Cook. But is it really that simple? Of course not. The spark came from Federal Housing Finance Agency Director Walter filing a criminal referral with the Justice Department, accusing Cook of misrepresentations in mortgage agreements. Specifically, she was alleged to have registered 2 different properties as primary residences to secure better loan terms. A move that could legally be considered deceptive or improper. Trump seized on this, arguing she was unfit to serve at the Fed. Behind the scenes, though, this is about much more than one person's housing paperwork. For Trump, the Fed's independence and, by extension, control over monetary policy remains a pressure point he repeatedly pushes. That's why the market reacted so strongly. Instability within the Fed leadership has direct implications for the pace of rate cuts and investor expectations. The bond market reacted immediately with yields dropping, while equities took the news as bullish, betting that easier policy could now come sooner rather than later. That's how we ended up with bonds down, stocks up, and that's today's big takeaway. Maybe this shakes up what you thought you knew about markets, or maybe you see it differently. Do you agree, or do you have another perspective? Drop your thoughts in the comments below, and I'll pick some of them to highlight in the next episode. Don't forget to like and subscribe so you don't miss any updates. See you next time. The main issue centers on Lisa Cook. She was nominated by President Biden to serve as a Federal Reserve governor and became The first black woman in the Fed's century-long history to hold such a position, which naturally drew a lot of attention at the time. In fact, even before her appointment, she was somewhat controversial in financial circles. Some critics argued that her focus leaned more toward racial discrimination and social equity issues rather than the core expertise of monetary policy. While her academic background is indeed in economics and finance, her practical experience in monetary policy had long been questioned. Nonetheless, Cook was successfully confirmed in 2022 and later reappointed, with her term extending all the way to 2038. This means she will play a significant role in shaping Fed policy for many years to come. Since joining the Fed, her stance has largely aligned with the Biden administration and Chair Jerome Powell. During the height of inflation pressures, she consistently supported aggressive rate hikes. And throughout the 5 policy meetings in 2024, she voted each time to keep interest rates unchanged. More recently, however, as the labor market has shown clear signs of cooling, Cook began hinting that this could mark a turning point for the U.S. economy, something that deserves close attention. Trump, on the other hand, has been sharply critical of Cook, even going so far as to suggest that if he returned to office, he might fire Cook. But the market today is less sensitive to these kinds of threats than it once was. The reason is that investors have increasingly come to believe that, despite Trump's frequent public pressure, the Fed will still strive to uphold its independence. As a result, his remarks are seen more as political posturing than as a direct and immediate market-moving factor. Still, we can't ignore one important question: what happens if political interference genuinely threatens the Fed's independence? Market expectations would be shaken, and the effects wouldn't be limited to stocks but would ripple across the dollar, bonds, and the broader financial system. For example, yesterday the dollar dipped briefly before rebounding, ultimately holding steady within a weaker, sideways range. The bond market, however, told a more divided story. The 2-year Treasury yield, which tracks short-term Fed policy, fell, while the 10-year and longer-term yields rose. This divergence between the short and long end of the curve reveals a split in market psychology. On one hand, falling short-term yields suggest that traders are betting on future rate cuts. On the other, rising long-term yields show concerns about higher inflation risks over time. If investors believe Trump could sway the Fed toward looser policy, that may look bullish for asset prices in the short term but could also fuel inflation pressures in the long run, pushing up longer-term rates. This is why the yield curve spread has widened significantly, now at its steepest level since early 2022. But there's a flip side. If the rise in long-term yields stems more from optimism about U.S. economic resilience than from fears of runaway inflation, then it could actually be interpreted as a positive sign pointing to growth and continued support for industries and capital markets. In other words, if the Fed keeps rates elevated for a while but allows the short end to normalize lower, we could see a steepening yield curve. Historically, such a steep curve has often signaled stronger economic growth ahead. The latest data adds more nuance. The U.S. Consumer Confidence Index for August fell to 97.4 from 98.7, marking a slight decline but still beating expectations. The drop wasn't mainly due to inflation but rather uncertainty around the job market. In fact, the share of consumers saying jobs are harder to get hit its highest level since 2021. This ties directly to Powell's remarks at Jackson Hole. Inflation has stabilized, but the labor market is now the key focus. At the same time, Trump's tariff policies add another layer of uncertainty, making businesses more cautious with hiring and wage growth. That has slowed the pace of wage increases. On the surface, this might suggest weaker demand in the services sector. But from another angle, it shows companies are no longer forced to pay inflated salaries just to attract workers, meaning labor shortages are easing. More encouraging, however, are the latest durable goods orders, because durable goods tend to be big-ticket, long-cycle purchases. An increase signals that consumers still have confidence in the future economy, taken together with the yield curve dynamics. These signs suggest the U.S. economy is not headed for recession just yet. Instead, it continues to show resilience. In July, core capital goods orders rose 1.1% from the previous month, beating market expectations. This suggests that business investment sentiment continues to recover. Excluding volatile categories such as aircraft and defense equipment, durable goods orders tend to better reflect the true momentum of corporate investment. However, if we look at overall durable goods orders including aircraft, they fell to 8, mainly due to fewer Boeing orders. Previously, former President Trump had helped drive a surge in Boeing orders. So the recent decline looks more like a temporary factor rather than a sign of a cyclical downturn. Focusing on key categories such as electronics, computers, machinery, and metals, orders remained solid, with autos showing signs of recovery as well. This trend aligns with Fed policy. If the U.S. truly enters a rate-cutting cycle, both housing and autos could receive an additional boost. For households with rigid demand or strong consumption willingness, lower rates would serve as an important catalyst. Overall, U.S. business investment is still moving forward steadily, especially in the AI sector, where both hardware and software investment remain highly active. This implies that AI-related companies could continue to benefit from stock price catalysts. Turning to the S&P 500 yesterday, the broader market closed higher. While some mega-cap tech and software names underperformed, sector rotation was evident, with healthcare, industrials, energy, and utilities showing relative strength. Palantir rebounded about 2.4% after Monday's pullback. Concerns had risen over its CEO's frequent stock sales. But new SEC filings revealed that CEO Alex Karp actually bought 400,000 shares last week, helping restore some investor confidence. Although the stock remains volatile at high levels with a premium valuation, many investors still see strong long-term growth potential. Eli Lilly surged roughly 6% after its next-generation weight loss drug delivered impressive trial results, showing up to a 10.5% reduction in weight for type 2 diabetes and obesity patients. This breakthrough sparked strong market attention. Pharma stocks often stage sharp rebounds on positive news, but longer-term fundamentals and valuations still need to be considered. Meanwhile, Unitil Thun came under pressure in after-hours trading following news of expanded regulatory probes, which now cover not just Medicare subsidies but other business lines as well. However, with the stock already at multi-year lows, the market's reaction to the negative news has been relatively muted. For investors seeking stable, long-term positions, traditional industry leaders like UN may still offer appeal. In aviation, Boeing was back in the spotlight after securing a major new order with South Korea. Korean Air announced plans to purchase 103 aircraft worth about $20 billion, pushing Boeing shares up 3.5%. In reality, orders were never Boeing's biggest issue. Its backlog already exceeds 6,500 planes, with delivery schedules stretching over 10 years. The real challenge lies in ramping up production and improving delivery efficiency. Boeing's order momentum also lifted related supply chain players such as GE, which saw their shares strengthen. In semiconductors, beyond the much-anticipated NVIDIA earnings, AMD also staged a strong rebound yesterday. The key driver was its newly announced partnership with IBM in the quantum computing space. The two companies plan to combine IBM's quantum technology with AMD's CPU and GPU architectures to build a new computing platform. With initial results expected later this year, analysts responded by upgrading AMD from hold to buy against the backdrop of accelerating AI development. Many see AMD emerging as a credible counterbalance to NVIDIA, gaining a larger share of the data center chip market. Business competition always follows the same logic. No single company can monopolize the entire market. Both supply chains and customers want alternatives and checks. AMD's rise will inevitably challenge NVIDIA's pricing power and market dominance. So, has AMD had successful cases in the past? If we compare it with Intel, which is currently at rock bottom, the answer becomes quite clear. In the CPU market, AMD's market share was less than 1% back in 2018, yet after several years of relentless effort, it has climbed to around 21% today, not only narrowing the gap with its bigger rival Intel but even surpassing it in certain niche segments. This is exactly why the market now naturally expects AMD to replicate a similar success story in the AI processor race. For AMD, it doesn't necessarily need to become the industry leader overnight. as long as it can gradually expand its market share and convince investors that its total addressable market holds long-term growth potential. The stock price could see an exponential boost. Analysts widely expect that AMD's upcoming MI300 series, especially the MI300X data center GPU, could capture more than 10% of the AI accelerator market, posing a tangible challenge to NVIDIA's long-standing dominance. This expectation has kept AMD's stock relatively resilient in recent weeks. Some investors even believe that once NVIDIA's earnings are released, if the numbers are strong, it could indirectly lift AMD and the broader AI supply chain as well. Of course, beyond AMD itself, NVIDIA's supply chain also remains a hot topic, for instance, in the cooling solutions space. Vertiv has recently shown outstanding stock performance, rising about 2.3% yesterday. On the news front, Vertiv announced the acquisition of a Belgian software company specializing in energy and cooling management for AI infrastructure. This move strengthens Vertiv's competitiveness in offering system-level solutions. Unlike some Taiwanese cooling component manufacturers such as Aura's and Cooler Master, Vertiv emphasizes complete end-to-end solutions. Customers aren't just buying components, but a full suite of systems covering everything from power management to cooling. This positions Vertiv more favorably in terms of technical barriers, pricing power, and customer dependency, providing better revenue sustainability going forward. Previously, the market had worried that major clients like Amazon developing their own water cooling technology might undermine Vertiv's edge, but its latest acquisitions and partnerships show that it is actively broadening its service boundaries. For example, recent collaborations with companies like Oppo aim to expand Vertiv's integrated solution offerings. This explains why Vertiv's stock quickly rebounded after a brief pullback. Meanwhile, another sector that saw significant gains yesterday was nuclear energy and defense. The biggest catalyst came from the Washington summit between U.S. President Donald Trump and South Korean President Lee Jae-myung. The two leaders focused on trade cooperation and defense security, with tariffs being the most closely watched issue. Trump ultimately insisted on maintaining a 15% tariff on South Korean goods. However, in return, South Korea pledged to significantly ramp up investments in the U.S., a total of $150 billion, spanning AI, biotech, shipbuilding, and nuclear energy. The scale of this commitment is striking. It's 6 times larger than South Korea's direct investment in the U.S. in 2024. Hyundai, for instance, will increase its investment budget for 2025 to 2028 from $21 billion to $26 billion and build a new steel plant in Louisiana to boost production and jobs. In aerospace, South Korean firms pledged to purchase 100 aircraft and signed a $13.7 billion engine procurement and maintenance agreement with GE Aerospace. In the energy and shipbuilding sectors, Korea Gas Corporation will begin importing 3.3 million tons of U.S. LNG annually starting in 2028. Forming long-term partnerships with American firms. On the nuclear side, Centrus energies and moves with 2 South Korean companies to cooperate on nuclear fuel enrichment technologies. This is particularly crucial given that the U.S. still heavily relies on Russia for reactor fuel. Congress passed legislation last year banning imports from Russia, making the partnership with South Korea especially urgent. If this cooperation accelerates America's domestic nuclear fuel capabilities, it could not only reduce reliance on Russia but also strengthen the U.S.'s competitive position in the global nuclear energy supply chain. Everyone knows that Trump has traditionally been against renewable energy sources like wind and solar. That's why recently, wind power and clean energy stocks haven't been performing well, but there's one big exception: nuclear energy. Trump has always supported nuclear power, not only because it can provide massive computing power for the future of AI, but also because it plays a crucial role in energy security and grid stability. For this reason, the nuclear sector has been one of the biggest beneficiaries lately. Take Centrus Energy ticker, LU, as an example. Its stock surged 13% yesterday. The catalyst: the U.S. and South Korea signed a nuclear cooperation agreement, witnessed by senior U.S. government officials. That means there's not only policy backing but also fresh external capital flowing in for companies in this space. That kind of support ensures more revenue stability and helps them expand without constantly worrying about funding or financing needs. In fact, Lu's stock has already skyrocketed more than 380% over the past year. This wave of nuclear exports could continue to boost other companies in the sector as well. Now, shifting from nuclear to another strong performer yesterday, the defense sector. The biggest driver here came from U.S. Commerce Secretary Lutnick's interview with CNBC. He hinted that the U.S. government may start using equity stakes as bargaining chips in future trade negotiations or corporate deals abroad. What does that mean? Essentially, if you want to secure contracts or form partnerships with foreign firms, the U.S. government might directly take an ownership stake in your company as part of the deal. That's a game changer for the market. Take Lockheed Martin, for example, as a traditional defense contractor, its stock has been relatively sluggish this year. But if the U.S. government steps in and takes equity positions, it's almost like saying to the market, "We've got your back, this is the floor." That kind of signal would immediately boost investor confidence and potentially draw capital back into these long, quiet defense giants. Keep in mind, about 80% of Lockheed's revenue already comes directly from the U.S. government, so the ties are extremely close. The question is, could this logic extend further? For instance, Palantir has been trading strong recently and is also a key government partner. If the government really wanted to go all in, could Palantir also become part of this equity strategy? That's just speculation on my part, but it's worth keeping in mind. More realistically, defense heavyweights like RTX Raytheon Technologies, Boeing, and General Dynamics are far more likely to be the first beneficiaries. Given the scale of their contracts with Washington, if a Trump administration truly pursues this strategy, these firms would undoubtedly be front and center. Of course, no one can say for sure how Trump will actually implement these ideas in the future, but judging from yesterday's market reaction, it's clear that defense and nuclear energy are the two sectors short-term money is most eager to chase. Alright, that's it for today's update. I'd love to hear your thoughts. What do you think about the possibility of the government taking stakes in defense companies? And which other names do you think could be affected? Drop your thoughts in the comments and we can discuss further. And just a quick reminder, if you want a more systematic way to track U.S. earnings reports and pre-market analysis, don't forget to subscribe to my newsletter. The link is in the info section. Wishing you successful investing this earnings season. May you go to sleep soundly and wake up to pleasant surprises.